Welcome to the Overberg Asset Management Market Review. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day, I'm Carel and Gielie, COO and Director at Overberg Asset Management, based in the Hermanus office. First, we're going to look at US interest rates and the flip side to that, obviously the inflation. Then I'm going to discuss an interesting article from Robert Armstrong, writing for the Financial Times, and he unpacks the recent developments in the US and his view on the US economy. Then over to the UK, where the Bank of England hiked rates last week. So we're going to chat a little bit about that. And then lastly, looking at the European debt. So first off, US interest rates and inflation. So last week, the Federal Reserve hiked interest rates by 0.75%, which puts the interest rate now at between 1.5 and 1.75%. And that came off the back of inflation that surprised the market on the upside. So inflation in April was starting to trend down, and then when the May figures came out at 8.6%, the news were that inflation was actually accelerating again. That obviously prompted the Federal Reserve to take aggressive action, hiking rates by 0.75%, where the market probably more expected 0.5%. So that's kind of put the whole thing a little bit of uncertainty in the markets, because everybody is now unsure exactly where the terminal rate would be and how quickly they will get there. So from some corners of the market, people are actually asking for a quicker or a more steep rate hike of 1%. But I think the Federal Reserve tried to strike a balance. So from Capital Economics, their interest rate expectations, they think at the end of 2022, we're going to have interest rates of 2.5 to 2.75%. And then by mid-2023, that's looking more like 3.25 to 3.5%. So there's still quite a bit of rate hiking to come. And I think with that, obviously, market volatility will remain. So according to Capital Economics, their big picture looks like this. They believe that the global recovery will continue to disappoint and growth will be below consensus expectations across all the major economies. They believe central banks will continue to hike rates despite the economy softening, and that's obviously to bring inflation under control. And I think what we've seen now with the Fed is that they're really starting to worry, and they want to get ahead of the curve with inflation. So, looking to probably hike rates more aggressive at the start and then tapering off as inflation cools. So furthermore, bond yields will keep rising as global monetary tightening cycle continues, as the discount rates will be adjusted upwards, and together with ailing economies, risky assets will come under pressure. And I think we've kind of seen that already in the last couple of weeks. The sell-off we had in the US last week when interest rates went up higher than expected, that had a filter down effect on all global markets, stock markets. So Capital Economics also believes that the rotation from growth to value will continue. So that's moving from the tech sector to the more defensive stocks. So then over to the article from Robert Armstrong, and he unpacks the recent developments in the US as follows. So he says, after the Fed hike rates last week, there was a clear signal from the market when there was a significant sell-off, and the S&P dropped 5.8%. So stocks fell sharply, bond yields fell, And all of that points to the markets believing that there's a recession coming. The Fed needs to cause a recession to get inflation under control. That's his view. They need to cool demand to really bring that inflation. And he believes that a recession is probably inevitable. However, he points there's some facts that could lead to a range of different possible outcomes. So the following is a couple of facts that he sort of then looks at to then come to some sort of conclusion at the end. So the first one there, the labor market remains strong to very strong in the US. There's probably twice the number of jobs for each applicant. So labor market remains strong. From March or April, the following items grew in real terms. So we had personal consumption, industrial production, and business investment. So that's obviously quite positive. However, anecdotal examples from companies and certain industries actually show that cracks are appearing. So that's a bit of a negative. Then also on the negative side, sentiment surveys at the moment is quite terrible. And those include business sentiment and also consumer sentiments. And that is mostly from rapid rising prices. So although they're quite negative at the moment, there's no noticeable effect on activity at this point. Then also on the negative side, the housing market is slowing down quite rapidly. New home sales are down, as well as building permits. They were all trending down quite sharply. And that's kind of unsurprisingly if we think that interest rates are rising. Then a mixed signal were the May retail sales, which was down 0.3%. But if we exclude auto sales, retail sales were actually up 0.5%. That could also be an indication that there's a continuation of the rotation from goods to services. And also, auto sales are quite volatile in the last year due to supply chain disruptions. So there's a bit of a mixed signal there. Then another slight negative is that jobless claims are starting to tick upwards. It's still at very low levels. So based on the points above, the US economy is starting to slow, but it's not broad based. It's mostly in housing that there's quite a significant drop down. So I think although he believes that a US recession is probably on the cards, it's still a question on how deep that recession would be. Over to the UK. So last week, the Bank of England also hiked interest rates. They set the benchmark rate to 1.25%, and that's a hike of 0.25 percentage points. It was much lower than obviously what the Fed did. And the Bank of England has actually been criticized for not taking more aggressive action to really get inflation under control. So inflation in April was 9%, and the figures came out this morning for May, and it was expected to be 9.1%. So it came in at that level, and the increase was mostly due to food prices going up. So there's another thing happening with obviously with the Bank of England not hiking rates at the same pace as the US. It's causing pound to weaken. So in the last year, the pound has lost just over 11% of its value to the dollar, which means that it could lead to further price rises and intensify the cost of living and put consumers under even more pressure. So as the pound weakens, imports become more expensive, and essentially you importing inflation. So some external monetary policy members were actually calling for for a higher interest rate hike of 0.5%. I think there were quite a few people inside of the Monetary Policy Committee that also called for that, but in the end it went at 0.25%. But obviously they fearing that if the Bank of England don't keep track with hiking rates at the same pace as the US and other developing countries, that will obviously cause the pound to weaken even further. So the Bank of England expect GDP to actually contract in the second quarter, and that follows a 0.8% growth in the first quarter. So their long-term view on inflation is that they will be able to bring it down to the 2% target within the next 3 years. Okay, then finally, just going over to the European debt and looking at the spreads on the Italian and German 10-year sovereign yields. They've widened significantly in the last month or so. At the height, quite recently, they were at 2.4%. And last week, the EU basically announced to say that they will support the Italian bonds, and those spreads then dipped down to 2%, but they're still quite high. And it's kind of bringing back memories of the European debt crisis of about 10 years ago. So why is this happening? Italy and a lot of the peripheral EU countries like Greece, Spain, Portugal, I think they were dubbed the Club Med countries. They all have debt now that's even higher than 10 years ago. So with all the support during the pandemic, all of these countries have racked up quite a bit of debt. So, these higher interest rates obviously throttle growth. Households own a lot of this debt, which creates negative wealth effects. The banks, their balance sheets becomes weaker, so they're less likely to extend loans. And obviously also, if we have troubles in the bond market in Europe, there's that contagion effect, which might also drag down other asset classes. But the ECB will have to commit to some sort of bond buying program or a way to cap the spreads. And that's it from me.
Thank you, Carel, for a very interesting macro overview. From the local side, just a few companies reported. It's really just updates, not financials. Process, they said that their HEPS, their headlines earnings per share for the year to end of March will decline between 14 and 21%. The results will be out next week. And the same for Naspers. They also expect their HEPS, their core headline earnings per share, to decline between 8 and 15%. The results will also be out next week. Then Raubex, we own Raubex, very good company. It's got zero debt. A director bought shares in the company to the value of 400,000 rand. And there has been quite a bit of buying by directors of shares recently. And it's normally a good signal and a strong signal. City Lodge, they also had an update. They went through a very tough time with COVID, of course, but at the moment they're running at a 47% occupancy. 47% of their rooms are full, which is good. That's nearly break even. Their break even point is at about 50%. Over 50% they start making money. Then Sirius Real Estate is one of the shares that we hold. They operate in Germany, and they just announced that the company Aberdeen bought shares in the company. They now own 11% of the total ordinary shares in the company. A few minutes ago, Stadio announced that their students, they've got nearly 33,000 students now. It's an update from 28,000 students last year. It's a 15% growth. And then I just had to look at the JSE this morning. The earnings yield on the JSE this morning is 9.25%, which is very, very high. Thank you very much. That's all from me, Carel.